first part of Chapter 2, the Domestic and International Financial Marketplace. This chapter provides a look at the domestic and international marketplaces within which firms operate. This will provide an overview of the operation of the U.S. and international financial systems, distinguishing between the money and capital markets. The major financial intermediaries are discussed, and the operation and structure of secondary security markets are presented. This chapter also illustrates how to calculate holding period returns for any investment. Income taxes and financial management. A knowledge of tax laws and regulations is essential in making a wide variety of business decisions that affect shareholder wealth, such as what form of business organization to select, what types of securities to issue, and what investment projects to undertake. Income tax is a type of tax that governments impose on income generated by businesses and individuals within their jurisdiction. By law, taxpayers must file an income tax return annually to determine their tax obligations. Moving on, financial management means planning, organizing, directing, and controlling the financial activities such as procurement and utilization of funds of the enterprise. It means applying general management principles to financial resources of the enterprise. Implications of income taxes for financial managers. Although the effect of income taxes on financial decisions is discussed in detail where appropriate throughout the book, a brief review of some of the critical areas of concern is provided in this section, such as capital structure policy, dividend policy, capital budgeting, and leasing. Capital structure policy. Theoretically, the financial manager should plan an optimum capital structure for the company. The optimum capital structure is one that maximizes the market value of the firm. The capital structure should be planned generally, keeping in view the interests of the equity shareholders and the financial requirements of a company. While developing an appropriate capital structure for its company, the financial manager should inter alia aim at maximizing the long-term market price per share. Next is dividend policy. This refers to the explicit or implicit decision of the board of directors regarding the amount of residual earnings, past or present, that should be distributed to the shareholders of the corporation. The third one is capital budgeting. This is a long-term planning for making and financing proposed capital outlay. This is a decision-making process through which a business concern evaluates the purchase of various fixed assets for expansion and replacement. In other words, this is a planning of capital expenditure which provide yields over a number of years. Leasing is a process for which a firm can obtain the use of a certain fixed assets for which it must pay a series of contractual, periodic, tax-deductible payments. An overview of the U.S. financial system. The U.S. financial system serves an important function in the efficient operation of the economy. The financial system is the vehicle that channels funds from saving units or savers to investing units. The rates of return that investing units must pay for the capital supplied by savers are determined competitively in financial markets. In considering the economy as a whole, the actual savings for a given period of time must equal the actual investments. This phenomenon is called the saving investment cycle. Table 2.1 presents a summary of the saving investment cycle in the United States for 2002. Total gross savings for that year equaled $1,565.1 billion. $285.8 billion from personal savings by individuals, $1,303.8 billion from business, and negative $24.5 billion from government. This last figure is a combination of federal, state, and local surpluses. Gross investment also totaled $1,565.1 billion, $1,593.1 billion in gross private domestic investment, $351.9 billion in government investment, less $488.9 billion in net foreign investments. This latter figure indicates that investments of foreign entities in the United States exceeded the investments of U.S. entities abroad by $488.9 billion. Because of estimation errors, there is a statistical discrepancy of $108.9 billion. The saving investment cycle depends on net savers, or surplus spending units, and net investors, or deficit spending units. The cycle is completed when the surplus spending units transfer funds to the deficit spending units. The main purpose of the U.S. financial system, including the financial markets and all financial institutions, is to facilitate this transfer of funds. Figure 2.1 graphically depicts this continual flow. Funds flow from surplus through financial middlemen and financial intermediaries. Financial middlemen include brokers, dealers, and investment bankers. These securities are called primary claims because they are sold directly by the borrower and bought directly by the saver or lender. Financial intermediaries differ from financial middlemen in that they issue secondary claims to the ultimate lender instead of primary claims. Financial assets. A financial asset is a liquid asset that gets its value from a contractual right or ownership claim. Cash, stocks, bonds, mutual funds, and bank deposits are examples of financial assets. Financial markets refer broadly to any marketplace where the trading of securities occurs, including the stock market, bond market, forex market, and derivatives market, among others. Financial markets are vital to the smooth operation of capitalist economies. Money and capital markets. Money markets is an organized exchange market where participants can lend and borrow short-term, high-quality debt securities with average maturities of 1 year or less, while the capital markets refer to the places where savings and investments are moved between suppliers of capital and those who are in need of capital. Primary and secondary markets. Primary markets are investors who purchases new securities, while secondary markets are investors who resells existing securities. Financial intermediaries. A financial intermediary is an entity that acts as the middleman between two parties in a financial transaction, such as commercial banks. This is where most people do their banking. Thrift institutions is a financial institution that obtains the majority of its funds from the savings of the public. The term can include several cooperative banking models, savings and loan association, mutual savings bank, credit union. Investment companies. is a corporation or a trust engaged in the business of investing the pooled capital of investors in financial securities. This is most often done either through a closed-end fund or an open-end fund, or also referred to as a mutual fund. Pension funds are investment pools that pay for workers' retirements. Funds are paid for by either employees, employers, or both. Insurance companies, a financial institution that provides a range of insurance policies to protect individuals and businesses against the risk of financial losses in return for regular payments of premiums. Finance companies is an organization that makes loans to individuals and businesses. Unlike a bank, a finance company does not receive cash deposits from clients, nor does it provide some other services common to banks, such as checking accounts. The next topic is the structure and operation of U.S. security markets. Outstanding securities are traded in the secondary markets, where owners of the securities may sell them to other investors. The corporation whose securities are traded in the secondary markets do not share in the proceeds from these sales. Security exchanges and stock market indexes. Secondary markets can be classified as either listed security exchanges or over-the-counter or OTC markets. Listed security exchanges operate at designated places of business and have requirements governing the types of securities they can list and trade. On the other hand, over-the-counter markets do not have centralized places of business, but rather exist as networks of security dealers connected by a communication system of telephones and computer terminals that allow the dealers to post the prices at which they are willing to buy and sell various securities. Stock market indexes. Stock market indexes give a broad indication of how the stock market or a segment of it performed during a particular day. The most frequently quoted stock market index is the Dow Jones Industrial Average or DJIA, which is based on the stock prices of 30 large, well-established industrial corporations. Figure 2.3 provides a listing and data on major stock market indexes. Regulation of the security markets. Combined with the 1929 stock market crash and the general reform spirit of the 1930s led to the enactment of two principal pieces of security legislation: the Securities Act of 1933 and the Securities Exchange Act of 1934, and the establishment of the Securities and Exchange Commission or SEC. This federal legislation has been aimed primarily at ensuring full disclosure of security information. The global economy and multinational enterprises. Global economy refers to the interconnected worldwide economic activities that take place between multiple countries. It refers to the exchange of goods and services between different countries, and it does also help countries to specialize in products which they have a comparative advantage in. And the multinational corporation is a business organization whose activities are located in more than two countries and is the organizational form that defines foreign direct investment. Foreign currency markets and exchange rates. The foreign currency markets is an over-the-counter marketplace that determines the exchange rate for global currencies. It is by far the largest financial market in the world and is comprised by a global network of financial centers that transact 24 hours a day, closing only on the weekends. And the exchange rate is the value of one currency for the purpose of conversion to another. The euro currency market. A euro currency is a currency that is deposited in a bank located outside the country of origin. These are created when, for example, A U.S. firm transfers dollars from a bank in the United States to a bank outside the United States. Also, someone outside the United States may receive dollars in connection with a business transaction or because of a purchase in the foreign exchange market. When these dollars are deposited in a bank outside the United States, they become euro dollars. And the interest rate in the euro-dollar market is usually related to the London Interbank Offer Rate, or LIBOR. LIBOR is the interest rate at which banks in the euro currency market lend to each other. A common European currency. On January 4, 1999, 11 countries of the European Union, or EU, turned over control of their monetary policies to a new European Central Bank, and the single European currency, the euro, was born. During the transition period, the euro was being used only for paperless transactions, but on January 1, 2002, euro bills and coins began circulation, and 6 months later, the national currencies of these 11 countries ceased to exist. This move toward a single European currency is the logical outgrowth of the development of a single European market where goods, services, and people flow freely across national borders. Direct and indirect codes. Exchange rates can be expressed as either direct codes or indirect codes. A direct code is the home currency price of one unit of foreign currency. For example, from the perspective of a U.S. firm, a quote of $0.88 per euro would be a direct quote. An indirect quote is the foreign currency price of one unit of the home currency. A quote of €1.1364 per dollar would be an indirect quote from the perspective of a U.S. firm. Spot rates. Exchange rates between US dollars and the currencies of most countries are reported daily in the Wall Street Journal. Table 2.2 lists the direct quote exchange rates between US dollars and various currencies as of November 15, 2001 and February 20, 2004. Spot rates represent the rate of exchange for currencies being bought and sold for immediate delivery. In addition to spot transactions, currencies can also be bought and sold today for delivery at some future time, usually 30, 90, or 180 days from today. In these cases, forward rates are used rather than spot rates. Forward exchange rates between US dollars and the currencies of several of the major industrial countries are also reported daily in the Wall Street Journal. Table 2.3 lists some forward exchange rates as of February 20, 2004. A comparison of the spot and forward rates in Table 2.2 and 2.3 shows that the 30, 90, and 180-day forward rates for each of these currencies is below its spot rate, with the exemption of the Japanese yen and the Swiss franc, indicating a market expectation that they will lose value relative to the dollar over these time horizons. The premium or discount between the spot rate and the forward rate for a currency or relative to the dollar, for example, can be expressed on an annualized percentage basis or using direct quotes as follows. Where N is the number of months in the forward contract, a positive value calculated using equation 2.1 indicates that our currency is trading at a forward premium relative to the dollar, whereas a negative value indicates a forward discount. Using the exchange rates from Table 2.2 and 2.3, the following annualized premium for the 6-month forward quote on the Canadian dollar can be calculated, as shown in equation 2.2. Thus, we can say that the Canadian dollar is trading at a forward discount relative to the US dollar. That is, the US dollar is expected to strengthen relative to the Canadian dollar. To be discussed later by the next reporters, firms engaged in international transactions can use the forward foreign exchange market to hedge against the risk of adverse fluctuations in exchange rates. So stay tuned for that. Hey everyone, that would be all from my report. Thank you for watching, and I hope you learned something from me. By the way, the continuation of Chapter 2 will be reported and be posted on Miss Katharina Valenzuela's YouTube channel. Watch it and learn more about Chapter 2. Thank you, and God bless us all.